Thank you very much, Robert. I was happy to come to this conference and be able to speak, but now I'm thrilled because last time I came, I heard speakers with a lot of talent, and today I didn't think that this could happen in the next couple of years, but it happened today. 3 speakers out of 3 are talking about cycles. So thank you, Julian. Thank you, George. George had been very cynical but constructive. I can be as cynical as George because this industry is not a buy and hold. This industry is cyclical. And I will talk about cyclicality. And this is mainly the focus that I want you to understand. So George and Alain will not necessarily agree, but we will agree on the conclusion. I do think that we established a world record talking about cycles in the timing of the current cycle. I was over the Atlantic this summer, and for the first time ever I heard the people referring to this gold bull market as a cycle, as a new cycle. And this is exactly what we have been talking about at Finance SA for the last 3 years. So my focus will be cycles, but that's not the theme of this speech. But George will allow me to emphasize a little bit this topic. And finally, I would also like to thank Ignacio, because I've known Ignacio for the president of Eurosur. For 3 years now, I've been following him on a very regular basis, and when a person in the audience asked him, what is your competitive advantage? And I had the answer for you, Ignacio. I don't know where you are in the room, but there you are. You are honest and you execute. So now that we have made this very clear, I don't know many companies that are trading at these valuations. I don't. 30 million market cap, 30,000 ounces of gold of production per year, no debt, cash, with exploration potential. I can bet you lunch or dinner, and I'm not a shareholder, by the way, of Eurosur. And I can bet Ignacio one dinner or lunch that 1 year from now, your stock will be at much higher multiples, trading much higher multiples. Okay, so let's get down to the topic. As I said earlier, gold and gold mines are cyclical, and I'm not going to spend much time on it, but you will see 2 charts. And I think that any 7-year-old boy or girl can understand what we mean by cycles. We'll talk about fundamentals of the gold, bullion, physical gold, because you also need to understand why we think that gold is going higher. And I have some key fundamental elements that support this statement. And we'll talk also macro. We need to talk macro because if we don't talk about macro, we cannot understand gold. And finally, we'll probably skip and go straight to what to look for. This is the theme of this presentation. So these are the gold mines, and these are the way they behaved over the last 30 years plus. So when we say that this industry is cyclical, it means that when cycles are bull cycles, those gold names can go up by 100 to 300%. And the 300% that you saw in the last run actually should have been 400% and 500% had the mining companies been more disciplined. Because in that same time frame, gold had gone up from $300 to $1,600, $1,700, $1,800. So those 300% should have been much higher. So when we're talking about gold mines, we're not talking about the 25, 35% return, expectation of return, but we're talking about 100+%. And we did start a new cycle. This is our statement. We did start a new cycle at the end of 2015. And we started this new cycle. This is the gold billion now. And I will ask you to focus on the rectangle, the red circled rectangle that shows, and I'm sorry, George, I'm going to talk about averages, that shows that from September to 2011 to the end of 2015, gold price went down by 44%, and the duration of this bear market was of 52 months. That compares to the average of the previous bear cycles of 47 months with a 44% correction, to be compared to the median of 52 months with a 43% median correction. So what happened at this time? We had the Federal Reserve that made a clear statement at the end of 2015, this is where we were, 2015, that made the statement that from now on we're going to evolve in an environment where real interest rates will remain low for long. And this is when they refer to equilibrium level of real interest rates. And that was the trigger point that sent the signal that after gold retracing 50% of its gains versus gold mines retracing 100% of their gains on the same time frame, which is 15 years, we had this reversal. And we had this reversal not because we ended the cycle, but because the Federal Reserve made it clear that real interest rates were going to stay low for long. And this is exactly our point. The biggest correlation with gold price is real interest rates, and it's not perfect, it's at 65%. But this graph shows you, that's a 10-year chart, how gold behaves with real interest rates. So when the most powerful central bank is telling you that, guys, don't worry, from now on, and for a long period of time, we're going to evolve in a low environment for real interest rates, this was really what the market wanted to hear. So first element, real interest rates. And we can talk about why the normalization has really made the picture a little more blurry, and why over the last year the market seems not to know where it's going. And I will answer the questions on normalization if you want, but the second highest correlation, and it's negative, it's the US currency. And that correlation is about 50%. So you have one chance out of two to be right or wrong. So you flip a coin. But when you have real interest rates going down or staying low for long, when you have, which was our theory, and it was more than a theory because it was based on the historical pattern of the U.S. interest, the U.S. dollar, when central banks were starting to tighten the monetary policy. Well, this is each time the central bank basically tightened its monetary policy. That was post-1980, so post-hyperinflation environment of 94, 2004, 2009. Each time the dollar declined versus its peers and didn't appreciate. And the logic is very simple. When you know that the monetary policy is going to tighten, everybody's going to bid for the product. And when actually the policy is implemented, well, it's time to take some profit. So, and this is exactly what we had. Gold went up, and the dollar went down by 9%. And the final correlation that we always have to look at is commodities in general. And this is a long-term graph too, gold in yellow, and the Bloomberg Commodity Index. I could have taken another global commodity index, but our point here is to say that the major correction in commodities is over and should not weigh on the price of gold. We're not saying it's time to buy copper, zinc, nickel, or iron ore, or coal, but it's definitely because of the nature of the restructuring in that industry. Today, we believe that the commodities in general will not weigh down on gold price. So we had everything in place at the end of 2015 to give us a green light for higher gold price and higher gold mines. And over the last few months, because the investor is always very impatient, it's not like a parent who is more patient with his or her child. A lot of, inside the office too, I had a lot of voices coming to me and saying, but Alain, why are gold mines not performing? Why aren't they doing, are they going up when gold was going up? And the answer is very simple. You cannot just decide that your start of the analysis is April 1st or June 2nd. The reality is that this gold cycle started almost 2 years ago, and gold mines have appreciated by 63% versus 13% for the gold price. So if somebody tries to sell you gold versus gold mines, she's got a lot of good reasons to do so, but do not come to us by saying gold mines have underperformed the gold price, because this is not the reality. The leverage is intact, and it should get even better after this year of observation. And when I say that we've got several years ahead of us, I'm looking at this chart and, of course, at the duration of the previous bull cycles. But in a nutshell, this is the ratio of gold mines versus the gold price over the last 30 years. And I'm not going to bore you with net asset value or free cash flow, which actually I don't like personally. The reality is that on that metric, gold mines are significantly undervalued to the gold price. I'm not telling you that it's time to buy gold mines whether or not gold goes up. Gold has to go up for gold mines to retrace some of the lag that they have. So we've got plenty of margin for those actors in this industry to catch up, but for that they need a higher gold price. And when we're talking about cycles, again, we're talking about margins. And we're talking about readjusted net margins. And this is exactly what I tell the prospects, our investors in our fund. They are telling me, but Alain, we know that at the peak of the cycle, assuming that you're smart enough to recognize when the peak of the cycle is, which I'm not, you will still sell us the story and tell us it's still time to stay. And the reality is that one element that you should all look at is the profitability of this industry. When those gold mines will start generating net margins after tax, readjusted on a scale, on a linear scale, well, when those gold mines will start reaching an average of 20% of net margin, then you will have your orange flag that tells you, okay, maybe it's time for me to start looking at this sector in a different way, or a more skeptical way. But until this happens, we have a long lead ahead of us that should enable the industry to generate those 20% net margin difference. So in this fund, what are we looking at? So I was on the sell side for 18 years. I've been on the buy side for 9 years. The business of the sell side, as far as I'm concerned, was exactly the same as what I'm doing today, which is finding the right companies that would generate the highest return for the investors, the quality return. So, and we all agree, management. So we want the right expertise because the right people can make a mediocre asset work. When gold was going down, when nobody wanted to hear about the sector, all the industry started focusing on higher grade deposits. The reality is that, yes, on average, a higher grade deposit will be more profitable, but this is not, you cannot make it a general statement. In fact, we have several examples of mining companies which have great boards, great executive directors, who manage to make money out of average assets. So management is key. Second thing about management, assuming something goes wrong, and in this industry always something goes wrong. If you have the right people, you know that they are smart enough, talented enough to rebound on a mistake that they made. And that's what I call, we need to look for a management that has a plan B in case something wrong happens, and obviously always, most of the time, something wrong will happen. And the one that comes to my mind is OreCorp. I don't know if you heard about this company. How many people know OreCorp in this room? Okay, 1, 2, 3. This company was a 100 million market cap company that was less than a year ago. And they happened to have a joint venture with Acacia, and Acacia is the African subsidiary of Barrick Gold, the biggest market cap in this industry. And Acacia was working with OreCorp on an asset in Tanzania. And Acacia had been working in Tanzania for the last 20 years with no hiccups and being the biggest gold producer in that country. And suddenly you have a new president being elected, and the rules change to the point where the new president of Tanzania accuses Acacia for doing a lot of bad things and asking for fines that would exceed $150 billion. $150 billion, so that you understand what it is. It's 2/3 of the total global market cap of all the gold mining companies in the world. Okay? So you understand that it doesn't make sense, but the fact is Acacia went down, and OreCorp, which has the sole asset as a JV with Acacia, the stock price went down from $100+ million to $30 million. Actually, it was divided by more than 4, so make it 130 million. We were shareholders of OreCorp, and we are still shareholders of OreCorp. And we had our reasons to be, and fundamental reasons to be shareholders, but we didn't foresee this problem. And what did the management do? The management understood that they couldn't stay hostage of a situation between two big players. So with 30 million market cap, with $20 million in cash, we are paying $10 million for half a 3+ million ounces gold deposit. So I'm talking about Australian dollars, so we're paying $7 the ounce of a deposit that might be one day be put into production, with the management willing to invest the cash it has in a new project. So this is what we call Plan B. We need a management not to react to a difficult situation. And finally, if you have the right management, you will ultimately get a premium, and the stock will be trading at a premium. And we've seen it with the big names that you all know, which is Agnico Eagle, Randgold, and so forth. Financials, quickly, in 5 minutes. The balance sheet. We don't like those debt equity ratio that are too high, but it doesn't mean that we don't look at those stories, because the biggest example that you can think of is Barrick Gold. Barry Gold, the most hated name in the industry in 2015, was hated because of its balance sheet and because of the negative view of the direction of the gold price. And what happened? Barry Gold happened when they had a change of management, when we understood what was the pedigree, what was the resume of this new management, basically former Goldman Sachs, head of Asia, and knowing that the mandate of this company was to reduce the debt by selling assets, and in that environment, who was the most likely candidate to buy assets was, of course, China. And this is exactly what happened. So we did understand what was going on. Barry Gold, not because it was one of the highest large cap of the industry, but because of this turnaround story, we had 9% of the fund in Barry Gold. And Barry Gold happened to have one of the best performance in 2016 among the large producers. So we are careful, but in some circumstances, we understand that this high debt equity could be an opportunity. Margins. Obviously, the higher you are profitable, the higher the market will pay a premium. So we always look at profitability and valuations. This for us is a really important key metric. And we can also try, if we are smart enough, to identify if there will be a new element that will enable the company to increase or decrease its profitability, depending obviously on the pipeline of projects that are coming on stream. Turnaround and special situations. Turnarounds, we don't have any in the portfolio today. They are hard to find. Special situations, we do have one that trades at a very, very, very low valuation. The name of the stock is Teranga Gold. Who knows Teranga Gold? One. Okay, several. This is probably one of the most hated names in the industry, and it has, coincidence, one of the lowest valuation in the industry. So we do believe that the mistakes that were made at the strategic level are all in the price of the stock. We think that the profitability trend is going to worsen, but the valuations are way, way, way beyond the norm. And in that specific example, we believe that this has become from a we don't know name to a no-go name. We believe that this name should hopefully deliver higher return than most of its peers. And finally, geopolitical risks and opportunities. One name comes to my mind, and it's Tahoe. I don't know if some people heard about Tahoe, but their first asset, not main, that first asset was a silver asset in Guatemala. The stock, there was a decision made by the Supreme Court to remove their license, and the stock went down by 40% in one day. That was an opportunity. We bought the stock understanding that this case had no merit, and we were building a position when, out of nowhere, that same Supreme Court launched a new decision that was way earlier than what we had anticipated, and the stock went up by 30% in one session. So we have to be always opportunistic. We understand that there are times when we need to be in this industry and times where we don't want to be in this industry. So those barriers are behind us. We have several years, good years, that are definitely pushing in our favor. And my point here is to say that over the lifetime of a mine has for most of them have never been profitable. So we're not selling the fundamentals of a mine that is profitable and great. And no, we are telling you it's the bottom. We have several years ahead of us. Things are improving at the bottom line. Things are improving on a macro environment, and let's take advantage of it. So we are here for several years, but then we'll have another bear cycle, and it will be time for all of us to dig our heads in the ground and wait for better days. 1 minute, we're fine? Thank you.
Thank you very much, Alain, for a very interesting, refreshing presentation. Do you have any questions from the floor in the real world? Okay, we've gone beyond the real world. Okay, we're directly into digital. There are a couple of very popular questions. Faz Moshfeghi again asks, many countries do not report their true gold holdings, for example, China and India. How does this impact your view of the market?
It doesn't, because when it's an unknown, it's an unknown. So until this unknown becomes known, and we don't see why it should be known, and we have no way to understand when or why it should be known, it's irrelevant for us.
Okay, so a couple of years ago we had a fantastic presentation. I can't remember who it was from. It might even have been from Faz, essentially saying that China is looking towards going onto a gold standard, and that actually to be able to underpin its currency with a gold standard, it would need something like 23,000 tons of gold in its stores. And the suggestion was that actually it's the Chinese that are underpinning the gold market by buying up gold progressively in order for the renminbi to become the de facto only major gold-backed currency. Agree or not?
I don't agree, because we won't be alive by the time this happens, first of all. And second of all, this is speculation, and I don't work on speculations.
Okay, fair enough. Another quick question. Is the genie out of the bottle for gold stocks? They didn't deliver real returns in the last bull cycle, so why should the stocks re-rate versus the gold price?
Well, we saw one graph with their profitability improving. That's number one. Second of all, before those same actors start lacking the discipline, it will take some time. I'm not saying that human nature is going to change. On the contrary, I think that because we believe in cycles, we believe that human being and greed will come back, and with greed you will have different valuations that don't really naturally make sense, and money will pour into this space when actually we won't need it, and it will be with the wrong prices and at the wrong time. So this graph should at least, I mean, the blue line is the median. Okay, so I'm not saying that. I'm saying that with those gold mines have restructured in 2013 massively. By massively, I'm talking about 30% of their total market cap went down the drain. 30% in 1 year. Out of 130 billion of market cap, 30 billion plus went down the drain in 1 year. That was what happened in terms of restructuring. So the cost went down, and whatever, this is the story you will hear around you. But the cost, I'm not saying that the cost will go down. The cost will stop going down. Actually, we are saying that the cost will go up, because you need to deliver growth. Now it's time to start again thinking about delivering growth, and the market will pay for growth. Just let me specific on one point. On the board of Barrick Gold, there are no explorers anymore. There are no geologists anymore. They are all financial people. So at some point, somebody will go and tell Barrick, I love you guys, but if you don't deliver growth, we're not going to keep paying the multiples we are paying today. So it's all about growth. It's starting to point its nose, and it will come back. It's just a question of time.
Okay, we have a real world question. Please give us your name and company.
Point of reservation. Catherine Roth, Chief Financial Officer, is a geologist. Unmarried.
I think you should take this one outside.
Okay.
Okay. Yes, please.
One more
Name
on,
and company.
oh sorry, James Clark, Bayswater Capital Partners. One thing I notice about this graph, particularly with a bit of a background in geology myself, is the average grade of those gold mines has dropped a lot over that period of time, right? So you're looking in the late 90s, perhaps what, 8, 10 grams a ton for a normal gold mine, and now it's perhaps 1 gram a ton. So it's what I would expect it to look like. No? Because you're
Not if you, we are in a financial market. We're not in on the ground. What I'm saying is that when margins are going up, valuations are going up. And margins didn't go up because yes, the grade did go down, but also a lot of components of those costs went up, especially inflation on all fronts. So it's not only the grade. Grade is not the only answer to the fact that those mines have been less profitable.
Oh no, of course not. But it's something
Inflation has played a huge role. But again, I feel like telling you now we're getting too much into the details. What is the reality? The reality is that those actors must improve their profitability. Unless if they don't do it, they will not deserve the new valuations of a peak of a cycle. And this is what it's all about. It's about delivering profitability.
Okay, unfortunately we've run out of time for other questions, but we did have a couple of fantastic other questions concerning Bitcoin. Has Bitcoin and other cryptocurrencies, have they attracted traditional retail gold buyers who would in previous cycles would have helped prices of gold stocks move higher? I think it's a very, very good point that gold grades have reduced overall so that mines would become less profitable and less highly valued. And another question is, if investors wanted gold price exposure, why not buy long-dated call options on gold rather than trying to pick a winning stock? Don't have time for those questions, all those answers, unfortunately, Alain, but they were great questions. But once again, let's join together to thank Alain Corbani for his excellent